Hey everyone, and welcome back to Everything About Accounting. Today's quick learning tip is all about the foundation of accounting, the accounting equation. So let's get started. At first, we try to figure out what the accounting equation is. The accounting equation is a simple formula that must always be balanced. It looks like this. Assets equal to liabilities plus owner's equity. Let's break it down. Assets. These are things your business owns, like cash, inventory, and equipment. Think of them as the resources you have. For example, cash, inventory, equipment. Liabilities. These are your debts, the money you owe to others, like loans and accounts payable. For example, loan, accounts payable. Owner's equity. This is the owner's investment in the business, their claim on the assets after liabilities are paid. For example, owner's investment. Okay, now let's try to understand, why is it important? The accounting equation ensures that everything in your financial statements balances. It helps you understand the financial health of your business at any given time. Now, we try to understand the fundamental equation by using a quick example. Imagine you start a bakery. You buy ovens worth $10,000, asset, with a loan of $8,000, liability, and invest $2,000 of your own money, owner's equity. The equation remains balanced. Assets, $10,000 ovens, equal to liabilities, $8,000 loan, plus owner's equity, $2,000 investment. Remember, every transaction affects at least two accounts in the equation, keeping it balanced. For a deeper dive into the accounting equation and how it's used in real-world transactions, check out the linked video in the description below. Thanks for watching. If you enjoyed this quick tip, hit that like button and subscribe for more accounting knowledge. Until next time, keep learning.